Good morning and welcome everyone to the Moneycontrol live stream. You're watching the opening bell and I'm your host Nikki Mirchandani. Well, Indian equity markets are poised for a lackluster start in absence of positive global cues. SGX Nifty at this point of time is indicating a mildly negative start coming in for the Wall Street. US tech stocks have ended lower on Monday. Apple, however, briefly hit that record high before it surrendered to some amount of selling pressure. Asian shares at this point of time wobbly as traders weigh Fed rates pause options. FIIs, a little bit of disappointment out there. They've sold shares worth around 700 odd crore and DIIs have bought shares worth around 1,195 odd crore. In terms of F&O Qs that we have, FII futures long exposure is at 50%. And option writers expect Nifty between 18,500 to 18,700 range to continue. It's Nifty Financial Services weekly expiry today. Expect the range to be around that 19,400 to 19,600 level. We're seeing long being built up based on the OI percentage, almost 53 stocks, including Oracle Financial, India Cements, India Bull Housing Finance, Lupin, and Deepak Nitrite, which have seen long build-ups. In terms of, what we have in terms of the long unwinding that's based on the OI positions, 42 stocks, including Hero MotoCorp, Info Edge, India Mart, Nestle, and AU Small Finance Bank. They've been seeing a long unwinding there. Well, I wanted to talk and dwell a little bit about the new kid on the block, IKIO Lighting. It's opening for subscription today. That's 6 June to 8 June. The face value is around 10 rupees per share and the price band is around 217 to 285 per share. So there is a window of 15 rupees price band out there. The issue size, the IPO size is 6.1 billion. That's almost 610 odd crore. Out of that, the fresh issue is for 350 odd crore. The offer for sale is around 260 odd crore and the lot size for this one is 52 shares. It remains to be important because it's, after a while that we're seeing an IPO, and that's also because of the improved market sentiment. But we're going to be discussing some of the stocks and strategies with Sudeep Shah, the Deputy Vice President, Head of Technical and Derivatives, who's going to be joining us just in a bit from SBI Securities out there. But before that, let's get going with the stocks that need to be on your watch list this morning, which includes the like of BHEL, State Bank of India, SBI Cards and Payment Services, and JK Cement, amongst others. Well, I'm going to first take up BHEL because it's a downgrade rating which is coming on that one. The target price has been slashed to rupees 61. And the brokerage, that is Nomura, basically says that there is a rising debtors which have been impacting the cash flow. There's a robust thermal tender pipeline which is offsetting otherwise weak operational performance of the company. So the pipeline looks attractive. The operational performance at this point of time isn't very encouraging. It has slashed the EBITDA by 13 and 4% for this financial year and the next financial year to factor in a delayed order inflow and still weak gross margins. Now fundraising plan coming in for two of them, State Bank of India and the SBI Cards. But first, for State Bank of India, the board is going to be meeting in on June 9 to consider raising of funds during FY24, and it's expected to be done via issuance of debt instruments in INR. Also could be in terms of the foreign currency on private placement basis. SBI Cards, another one which is where the company's board is rather approved raising of funds to an extent of 3,000 crore. This is going to be done via the issuance of non-convertible debenture, which is going to be taking in place in one or more tranches on private placement basis. JK Cement, that's another one that you need to keep on your list. It's going to be buying in 100% stake in Toshali Cement for rupees 157 odd crore. The board has already approved in the share purchase agreement with Toshali Cement for the acquisition of complete entire 100% stake. With this, Toshali will become the subsidiary of JK Cement, and this in turn will help the company to expand the footprint in the eastern region. So essentially, more consolidation coming in for the cement space right now. Sajal Glass, that's a small one and probably a little unheard name. But it's the company at this point of time. The board has decided to withdraw the QIP offer that it had planned in March. This was to an extent of 35 odd crore under the QIP due to the market conditions out there. But these are some of the names that we have on our list this morning. And of course, there are a lot of stocks that we need to keep an eye out on. IPO is one thing that I'd want to probably fixate and talk more about it. But let's actually bring in Sudeep and ask him about the strategy right now for Nifty and Bank Nifty. Good morning there, Sudeep.
Good morning, Nikki.
All right. So I'm just going to ask you about what's your strategy on Nifty and Bank Nifty right now. It's the market setup at this point of time in cash. FIIs have been sellers for the last 3 consecutive sessions out there. Option writers are suggesting of a particular level. How do you look at the markets right now with the RBI decision pending? Do you think investors or the traders should be on the sidelines before they take a move? What's your suggestion right now?
I don't think so that the investors need to worry here. The thing is that the backdrop is quite strong now. We are on a declining inflation trajectory. Inflation is kind of peaking out. We are not seeing any major catastrophic decisions from either central banks across the world now.
Sure.
Am I audible?
Yes, you're pretty much audible. Just that the audio wasn't really very clear. Please go ahead.
Yeah. So what I feel is that the setup currently is very strong. Last few days also, Nifty in the last week, Nifty was not able to cross 18,550, 18,600. But yesterday and today's opening is stating that it's now comfortable about that level. What we are also seeing is that the Bank Nifty has once again taken the leadership with Axis Bank, ICICI Bank, IDFC First Bank. They are right now shining. So my sense is that the Nifty could take support somewhere around 18,500, 18,530. And we could see this move extending up to 18,750, 18,800, which is the previous all-time high. Now, just the data setup, if we have to glance on 18,500, 18,600 puts have seen massive writing yesterday. Also on the upper end, 18,700 calls have seen some writing. So all in all, it could be a range between 18,500 and 18,750 on the upside. What we are seeing on the Bank Nifty though is that the call writers are still far away at 44,500 and the put writers are placed well placed at 44,000. So 43,800, 43,900 in case of any decline should act as a strong support. And on the upside, we could see this move extending up to 44,550, 44,600. Remember, it's just the ICICI Bank and Axis Bank that has moved in the last few days, and we have seen Bank Nifty comfortably sustaining above 44,100, 44,150. But if HDFC Bank also starts powering ahead, then it would be altogether a different game for Bank Nifty. So my bets are that we feel that 43,800 and 18,500 on Bank Nifty and Nifty should hold in the sessions to come.
All right, that's the word coming in. 43,800 and 43,900 is the immediate support level that we have for Bank Nifty out there. But Sudeep, in terms of 3 profitable bets for our viewers out there.
Since we are bullish on Bank Nifty, the first bet is on a banking stock itself, that is Axis Bank. Now, what we have seen is Axis Bank in the last 3-4 months had underperformed, but it did not break its 200 DMA. Once again, now it is forming a rounding bottom pattern, and it has given a breakout above 935, 937, and has shown some serious strength yesterday with put writing also happening at 940, 950 strikes, and we've seen some call unwinding of at the money strikes. So I feel from the current levels, Axis Bank could be bought with 930 stop loss and 985 target. The second stock could be Tata Power.
Sure,
Now,
Sudeep. We are going to be addressing in the second stock in just a jiffy. Before that, we're just going to be addressing in the market opens for you. Lackluster opening, just in case the way we indicated right at the start of the trade, we are looking at a lackluster start coming in for the markets, a flattish rather start in absence of any positive global triggers out there. 18,600 mark, that's been clearly taken off the table right now, and we're sitting at a level of 18,590. Remains to be seen if a momentum can build up from there on, but need to keep a close eye out on the way Nifty is behaving right now. Bank Nifty, some support out there, but not really strong momentum out there. Flat opening with positive bias coming in for Bank Nifty. Broader index, we're looking at a negative start again, a flatter start with the negative bias out there. In terms of the small cap index, there also we are seeing actually outperformance creeping into the market. Small cap index has been holding up for you with gains of around 0.3% out there. So clearly a good start coming in, at least for Bank Nifty out there, and the small cap index overall. In terms of the IT index, that's where the drubbing has taken place. Profit booking to an extent of 1.5% out for IT index. Pharma basket 2 has surrendered to selling pressure with losses of around 0.2% out there. Auto index, however, seems to be bucking the trend with gains of around 0.5% out there. In terms of the other sectoral indices that we have, consumption story that remains intact with gains of around 0.3% on the screen right now. In terms of the FMCG basket, the positive momentum continues there with gains of around 0.2% for Nifty FMCG. Infra is acting no different, probably the gains coming in to an extent of 0.2% for infra. Also, at this point of time, market remains below that 18,600 level out there. Nifty gainers, Adani Enterprises, Bajaj Finserv, Kotak Mahindra Bank, and also in terms of the other gainers that we have on our list right now, Maruti Suzuki, Tata Motors, and Eicher Motors. Look at that, it's just the entire auto index flashing right in front of you for the Nifty gainers. Grasim, Ultratech Cement, and Adani Ports. These are some of the other top gainers that we have on our list right now. In terms of Nifty losers, IT basket, Infosys, Tech Mahindra, HCL Tech. These are the top losers that we have on our list. And Wipro, Cipla, TCS, barring one pharma name, all of them are from IT. Auto counters are the one which are shining in bright, and of course some of the financial names like Kotak Mahindra Bank. We'd also like to see how BHEL has been doing. Nomura has come up with a downgrade rating for BHEL, and of course it's suggesting that the order inflow and the gross margins, they are expected to remain weak, and the order inflow is expected to percolate down later into the financials, which might just add to the pressure for BHEL. So BHEL right now is trading lower with losses of around 2.5% out there. Ultratech Cement is the one which is actually the top gainer, but JK Cement is the one which went ahead. It's a small player, right? And JK Cement has gone ahead and acquired in a company for a consideration of 157 odd crore, thereby leading to further consolidation moves coming in for the cement space. Right now, the stock is trading higher with gains of around 2% State Bank of India and SBI Cards. These were the other ones that we listed on the stocks to watch out for this morning. SBI, because of the fundraising plans, the board is going to be planning up for that. And SBI Cards, where the approval has already come in when it comes to the fundraising. So right now, barring BHEL, we're seeing some amount of lackluster, probably traction building in for all of them. JK Cement to an extent has also been reacting, but clearly the winners are auto stocks out there. Sudeep, coming in on this one, what do you like within the auto space? And of course, you could also, give us the second profitable call that you were suggesting before we had to address the market opening. I think you were talking about Tata Power.
Yeah. So what we are seeing in Tata Power is that stock had corrected all the way up to 185, 187. And we've seen a good recovery up to 215 to 18 now. The stock in the last few days has been able to sustain above its 200 DMA. It broke its 200 DMA last in November 2022. So it's after a while that the stock has recovered back, and now it's showing signs of a up move. So I feel from current levels, the stock could be bought, and the stop loss could be 213. And on the upside, we could see a move till 228, 232. The third profitable idea I feel would be Mahindra and Mahindra. We've seen a very good pullback in all these auto names, whether it is auto frontline auto stocks or auto ancillaries. But the kind of update that the company management had given few days back, and post that the move yesterday, which we have seen in M&M, I feel it's due for a next round of a bigger up move on cards. And I feel from current levels, the stock could be bought with a stop loss of 1360. And on the upside, we could see higher levels up to 1460, 1480 in the next few weeks to come, days and weeks to come.
All right, so that's the word coming in for M&M right now. And also, Sudeep, bunch of, we're seeing a lackluster start opening coming in for the markets. It's an absence of direction right now. After the market opens, what would you suggest our viewers right now? What is the strategy you think the viewers or the traders should deploy at this point of time? Are they better off being on the sidelines?
I feel now since we are just a bit far away, like 8th is the RBI policy, and even the global markets today are not that supportive. I feel today it could be more of a range bound day. So one should use the dips to 18,550, 18,560 to go long, and rises to 18,650, 670 to go short. So from an intraday perspective, shorting is what I'm meaning from a trading perspective. But for investors and traders who want to go long, they should wait and add on dips to 18,530, 18,560 kind of zone in case there is any immediate decline during the first half. So I guess rather than chasing, waiting and adding on dips would be a wise decision for today and tomorrow, because ahead of the policy, I don't think so that at higher levels, a lot of people would be willing to take that much of risk as the stakes are very high at these levels.
Sure, Sudeep. I mean, barring FMCG and auto baskets, these are the ones which are technically at their lifetime high levels, right? They're probably at their highs. What do you make out of, if we've spoken about auto, within the auto space, you like M&M, but IT basket, that was the one which is languishing at the bottom today. You like anything from that space, mid-cap IT probably?
Mid-cap IT, there are a lot of names like Zentech, these Sonata Software. Now, these names have really done well over the last few weeks, despite the IT index not performing, and the traditional mid-cap IT names like LTTS, LTIM. So these kind of names have not performed well in the last few days, but it is these second-line mid-cap IT names, Zentech or Sonata Software or Intellect Design. These kind of names have performed. So I feel now the names which I've just spoken, Sonata Software and the other two, they have already made a big move on the upside. So the risk reward there is not favorable. And now, once again, we require the IT index to move up. Otherwise, these stocks could go in a range, and I feel they are better avoided right now, because initially last week or 10 sessions back, we had seen some kind of a breakout in Tech Mahindra or the other names also, TCS, HCL Tech. But those breakouts are failing. Even the IT index is not able to sustain about 29,300, 29,500. So there is some kind of a disconnect with the main index. And I feel till the frontline index, the IT index does not move, we will not see any major move from here on in the mid-cap IT space. I feel it is better avoided. There are a lot of other profitable opportunities in other sectors, and investors should be looking at those opportunities and trying to capitalize on them.
All right, so that's the word coming in on the entire IT basket. Sudeep, but it's probably one of the lackluster openings that we have in the market like this. You also have an IPO which is coming in, and of course we're going to be talking about it in just a jiffy. Apart from that, any pocket do you find attractive that you think the traders could probably be looking at?
I feel capital goods is trying to make a comeback. Now we have seen Cummins, we have seen Larsen. They've shown some kind of Cummins is on a tearaway rally. There is, I guess, just a day of the results, it had fallen 5-6%, but that immediately got recovered, and we are seeing a very good up move in Cummins. I feel that stock is due for a big move on the upside. Now Larsen has also started taking support at 2210, 2230 zone, and today is witnessing some kind of a continuation move from yesterday. So from capital goods, I'm seeing a good traction. I'm seeing some good momentum in real estate also. Godrej Properties, if you see Prestige Estates. So lot of these stocks are also trying to make a move on the upside. So that's why I said no. While we were discussing about IT mid cap names, I feel a lot of other names which we are just discussing right now are much better off to add at current levels and trade from a short-term perspective rather than just trying to add IT stocks at lower levels.
Right, so that's probably the word coming in at this point of time. Clearly capital goods is the one where we're seeing a lot of traction building in. And in terms of the real estate sector and the index as a whole, we have seen that traction already being built in. Apart from Prestige Estates, do you think there is more scope of potential coming in for the real estate names out there? And also, I'm referring to this because ahead of the RBI monetary policy, we're expecting rate sensitives to be in action. Within that basket, it's a broad based theme that I'm talking about. Is there anything that can be highlighted?
If we see, say, apart from Godrej Properties and Prestige Estates, a few other stocks from the mid-cap space that have been doing well, and I feel the trend there is structurally strong. It is Anantaraj, it is Shobha Developers, Oberoi Realty. So all these top names have done phenomenally well. Now, add to that, the fundamentals are also in place for them. The sales which they are registering, the kind of data that the real estate we are seeing from the real estate side, I feel that the stocks are moving well and are complementing the on ground reality. So and if the RBI chooses to have a status quo, then I feel we could have a very big move in these names post the policy also.
Right, so that's the word coming in for the entire rate sensitives. But Sudeep, we're going to leave it at that. Thank you so much for taking out the time and speaking to us.
Thank you.
Right, I'm going to be addressing in the story for IKIO lighting. It's the new kid on the block and 610 crore. That's where the IPO size is. There are a couple of reasons that probably one should be looking at. Of course, it's an IPO which has come in on block after a while. That is also on account of the improving macroeconomics, the market situation out there. But there is very high client and revenue collection concentration, almost 90% from lighting. There is a big jump coming in from inventories, receivables and borrowings ahead of the IPO. So that's a little bit of concerns out there. But we're being joined by Mayuresh Joshi, who's going to be talking about the, about the fundamentals. And William, he's from, probably the research head from William O'Neill Research Company. It's a late start, Mayuresh, I'm going to say, but nevertheless, we have you here. And since we have you here, I'm going to be checking with you on what do you make out of the FMCG auto basket. Auto index is where, we're sitting at the highs out there. What's your assessment?
Morning, Nikki. Apologies for being late. Some technical snag at my end. Two things. One, I think for the universe as a whole, when you're talking about auto stocks, the momentum specifically for two-wheelers has been pretty strong. The volume growth for the better part of the second half of the last financial year and the numbers that we're probably seeing for the first 2 months of this financial year remain extremely strong and robust. The EV transition for the two-wheelers is a relatively easier aspect, and therefore I think the kind of launches that you've probably seen and more launches expected with input costs expected to go down further, a lot of the semiconductor issues behind us and pricing probably remaining on their side probably will ensure operating leverage plays out for most of the companies within this sector as well. So two-wheelers strongly placed within the auto universe, TVS Motors, Bajaj Auto remain above key pivot levels on the O'Neill lens and expected to maintain its momentum from a pricing and an earnings perspective as well. Within the four-wheelers, Maruti is very strongly placed, very strong data points this time round. The expectation in terms of more launches, both EV and otherwise, expected to help them maintain their market share. Competition intensity remains huge with the kind of SUV launches that you've seen from its peers. But even within the four-wheeler pack, Maruti probably remains strong. CV as a space remains extremely robust in terms of the infrastructure spending expected from the government. What you've probably seen in terms of more spending expected to come through in the second half will ensure that the CV market and CV players remain robust. And therefore, I think even within the internals, Tata Motors CV numbers were good. Eicher Motors, Volvo numbers were good as well. And similarly was the case with Ashok Leyland. As an ancillary, auto ancillaries will keep on doing well as a support to both OEMs and the replacement market. Therefore, this space looks interesting. FMCG volume growth is going to be a key factor in this quarter. How monsoons plan out, Nikki, are going to be extremely important. We have all been hearing about the El Nino effect. If that plays out in the second half of the monsoon season, there might be some patchiness as far as rural spending is concerned. And therefore, I think the intensity of El Nino will be a key determinant for the re-rating of FMCG stocks, specifically in the second half. If El Nino is not that intense, my sense in terms of the rural recovery, which is already underway, will be significantly better in the second half. And therefore, stocks like a Nestle, stocks like a Britannia, stocks like an HUL should start reacting better in terms of operating leverage.
All right, so that's the word coming in for the FMCG basket. ITC has been the one which has been outperformer out there, but clearly we're seeing a re-rating potential coming in for Nestle and HUL. Apart from that, Mayuresh, at this point of time, IT seems to be running out of luck. You know, the last time that we spoke, we probably spoke about how the earnings were disappointing for large caps and probably a little different for the mid caps. But clearly, the drubbing continues overall for the pack. Even in today's session, most of the losers are the stocks from IT pack. What do you make out of it? Do you still find that as a buying opportunity given the drubbing and the valuations now that the stock command?
So two aspects, large cap IT disappointed and mid cap IT outperformed in terms of expectations and in terms of commentary as well. So I think a lot of mid cap IT companies, LTI Mindtree, Persistent, KPIT, Sonata, portrayed very positive management commentaries. And therefore, I think the expectations in terms of how constant currency growth will be for better part of these mid-cap IT companies should be reasonably better as per management commentaries as well. The margin pressures obviously have come off for the sector as a whole. Wage hikes, what we had witnessed a few quarters before, are largely done with. Outsourcing costs had increased, but now they've stabilized at this juncture. And therefore, margins should remain extremely stable for the sector as a whole. Now, the key factor remains in terms of the impending slowdown and the earnings slowdown that you'll probably witness in the second half for the US markets. European markets are patchy and going through an interest rate curve hikes, which means that the earnings slowdown will be even more prominent for European companies. Within this spaces, BFSI, which is almost 35 to 50%, depending on which company you're looking at, and retail and manufacturing might actually feel the brunt, which brings us to the moot point, how much of order wins slowdowns can actually happen for the sector as a whole, specifically in the second half. With the run-up that we've seen specifically for the mid-cap IT stocks, Nikki, valuations have obviously become 2 times of the standard deviation in the past few quarters and years. And therefore, a clear pull-off is probably required for fresh entry points within the sectors. Even on the O'Neill lens, I think a lot of sectors and stocks within this sector are in late-stage basis and extended from their key moving averages, which means that pull-off is definitely required. How these quarters' numbers pan out will be extremely critical for the sector as well.
All right. I would also want to chat with you about the IKIO Lightning IPO. It's probably coming in after a while. I hope I got the name right in the first place, but it's a tongue twister there. But you know, in terms of the like-to-like peer group comparison for this one, Havells probably, Dixon to an extent, the certain segments, the lighting segment is probably some amount of comparables there. What do you make out of this IPO? It opens for subscription today, of course. Do you find it exciting? How are the fundamentals looking like? Do you see any concerns, or you like the business? How are you looking at it?
No, I mean, the numbers are quite okay, but I think there are better, as you rightly pointed out, better and larger peers in the market itself who have got a long history of moving across market cycles. Obviously, what these players witnessed, specifically in the COVID period, was an impending slowdown, which was very, very obvious. Input cost had risen. Again, I think the beneficiaries in terms of input costs going down are clearly going to be played out by the larger players. The distribution, the franchisee network is far more entrenched, which means that the kind of leverage that they probably get in terms of both new product and their existing traditional products can probably aid a lot of the earnings growth going forward. So I'll wait for the IPO listing on how it probably plays out. But I think the existing players have probably been there, survived different phases of the market, and have seen it all. So I think the gut feeling would be to go with the existing players at this.
Sure. Apart from that, Mayuresh, at this point of time, any other sector which looks a little more attractive? We've spoken about IT, we've spoken about the FMCG and the monsoons. Actually, I was also wanting to touch base about the cement space right now.
Yeah.
A couple of reports, there was a dealer check which came in and suggested that there is a price cut which has already taken place in the previous month on account of unseasonal rains in certain part of the country. And pan-India basis, we saw the cuts coming in. But at this point of time, it is probably we're sitting at the year which is marked by state elections and the year next, which is marked by central elections coming in. Do you think the demand is only expected to rise further, and this season probably wouldn't be a dampener for the space as a whole?
Should not be, because I think the kind of infra spending that is happening both at the central and the state levels should ensure that infrastructure support, which is required through cement, will continue. Having said that, I think the kind of volume growth that one really expects should continue remaining at a reasonable level going forward. What you're expecting in terms of input costs expected to go down will play out significantly in terms of both the reported EBITDA on an absolute basis and an EBITDA per ton as well. With the incremental capacities, both clinker and cement, both expected to come up in a very gradual manner. Utilization levels are expected to inch up quite significantly, giving leverage. And therefore, I think cement companies probably remain in a sweet spot. JK Cement, Ultratech probably remain one of the few players who can enjoy and reap the benefits of this operating leverage. Petcoke prices in terms of input cost have started coming off, which incrementally gives them an advantage of anywhere between 150 to 200 odd rupees per ton. And with crude prices expected to remain low, even the diesel and logistic costs expected to be better off by 50 to 100 odd rupees. So you're incrementally going to witness on a quarter-on-quarter basis an improvement of at least 200 to 300 rupees per ton based on just these two parameters itself. So yeah, I think the positive leverage and momentum might continue for a few of these things.
All right, Mayuresh, we're going to leave it at that. Thank you so much for taking out the time and speaking to us this morning.
Thank you so much.
All right, the next we have is a discussion about the new kid on the block, IKIO Lightning. That's the IPO which opens for subscription. And to take us through the financial, the business outlook, the peer group comparison and more, we're being joined by Sachin Pal, who's the senior research analyst at MC Pro out there. Good morning there, Sachin.
Yeah, hi, good morning, Nikki. How are you?
I'm doing good. Thank you for asking. I'm going to start off by asking you, what do you make out of the business? Essentially, how exciting does the opportunity look like? And what are the peer group comparison and the valuation stacking up?
Okay, so in terms of the business, it's primarily catering to the lighting segment. So around 90% of the revenues that they generate across comes from the lighting segment. And they're primarily a contract manufacturer to some of the branded players. So Philips, which is one of the largest players in the domestic market, is one of their biggest clients, and it contributes almost 50% of their revenues. Besides this, they have other 2 or 3 smaller segments which together contribute almost 10% of their top line. These segments are fairly small at present, but they're looking to scale up the business on those segments as well. Overall, the business has shown a strong growth in the top line over the last couple of years. And however, when we look at the industry landscape and the peer group, so the peer group, there are no like-for-like comparisons for this business because when you look at probably Havells has a segment which is in the lighting segment. Crompton also has a segment which caters to the lighting business. So there's no apple-to-apple comparison for this business at this point of time.
And how about the valuations at this point of time? Sure, we don't have a peer group comparison out there and a very little history for the IPO out there. But at this point of time, given the lighting segment valuation, do you find that attractive, or you think people could probably wait in for another opportunity coming in by there?
So when we look at the lighting industry as a whole and the results that most of the companies have posted across in the last couple of quarters, so the industry as a whole is going through a competitive landscape. So there's a lot of things going around in the industry, say from volume growth to the pricing pressures to the margins. So it's a confluence of factors that's affecting the industry, and the commentary is consistent across all the players from Havells to Crompton to Dixon to Ellen. So most of them have had flattish or negative revenue growth for the lighting segment of the business. And also the margin pressures are also there. So when you look at the lighting segment, there are primarily two aspects. One is the retail segment. The other one is the B2G, which is the government segment. So the retail segment is obviously very stagnant, and the new orders are not really kicking in from the government side as well. So things are not really looking very good from a demand perspective for the lighting segment as a whole. And it's become a kind of a commodity business with a lot of players within the sector. Within the unlisted space, we have Philips, of course, and then there's Cisco, then there's another Jaguar also recently entered into the lighting business. So it's a very competitive landscape for within the lighting industry. Taking into account the valuations of business are currently around north of 30 times earnings. So when you look at some of the peer groups, most of them are trading around the similar levels. But there are some concerns in terms of the balance sheet that the company has. So they have a big jump in terms of receivables and inventory. Just that could be a dampener in terms of the valuations when you look at that.
Sure, Sachin. So you highlighted about the business outlook probably not being that attractive. You spoke about a high concentration in terms of the client and the revenue. You spoke about the margins, which seem to be very high at this point of time. How about the cash flows?
The cash flows have also been actually negative for FY20 and FY21 actually. So and also in 9 months of FY23, the things are again not looking very great. So the inventories have jumped a lot, and also the receivables. But that could be a business seasonality issue. We need to wait and watch for that, how that pans out across in the next couple of quarters.
All right. So you've clearly flagged up some issues even with the balance sheet in terms of the business outlook, in terms of the concentration, in terms of the way the business has been stacking up. So that's probably a whole lot of risk appetite in for the subscribers or the traders out there, but that's not a recommendation coming in from us. We're just probably laying out on the table. Sachin, what's the silver lining for this one?
So their exports business has actually been scaling up very well. So from like around 10 crores, they've scaled up to almost 40-50 crores in the last 3 years. So that represents a very big opportunity within the lighting segment, and a lot of this within the domestic market are actually catering to grow across their business in the export business. So that remains a strong foothold for IKIO lighting as well as other players. So that needs to be watched out for sure.
All right, Sachin, we'll leave it at that. Thank you so much for taking us, talking to us and decoding this IPO and taking out the time and speaking to us this morning. All right, guys, with this, it's a wrap and goodbye from the entire team who puts this piece together. Thank you so much for watching. And please do post your feedback for us in the comment section below. Follow us on the link at the bottom of your screen. And for rest of the updates, stay tuned into moneycontrol.com and Moneycontrol app.